Dividend investing sounds like the responsible choice. Steady income, no selling, no timing the market. You pick an ETF that deposits cash into your account every quarter, and you call it done. For a lot of investors, that strategy is genuinely correct. But for anyone earning above $250,000 and holding that ETF in a taxable brokerage account, it is quietly one of the most expensive habits in their portfolio, and the cost does not appear anywhere on their dashboard. Today, we are going to run the actual after-tax math on $100,000 over 10 years. Not the surface return. The number that is left after the IRS finishes its portion. We are going to make the honest case for both sides, because this is not a simple growth win story. It is a context story. By the end, you will know exactly which side of the line you are on and what to do about it. I want to make the dividend case first. If I skip this, the rest of the video falls apart. The behavioral argument is the strongest one on the board. Hartford Funds research found that investors holding dividend-paying funds panic sell significantly less during bear markets. Why? Because a cash deposit hits your account every quarter whether the market is up or down. When your portfolio drops 30%, that dividend feels like proof something is still working. It keeps you in your seat. And staying in your seat during a crash is worth more than almost any optimization most investors will ever run. The second argument is retirement income. If you are living off your portfolio, dividends function like a paycheck. You spend the income. The principal stays. You do not have to decide what to sell or when. For someone drawing down in retirement, that structure removes one of the most psychologically grueling decisions in personal finance. That is a real benefit, not a minor one. The third argument is simplicity. You pick VYM. You automate contributions. You reinvest dividends. There is no rebalancing complexity. No tax loss harvesting spreadsheet open on a Sunday afternoon. For an investor who wants to set it and forget it, dividend ETFs deliver cleanly. So that is the honest case. It works. Under specific conditions, it is the right answer. Here's where the math changes. And I need to be precise about who this applies to. If you are a HEMRE, meaning high earner, not rich yet, household income above $250,000, and you are holding a dividend ETF inside a taxable brokerage account, the IRS is running a mechanism against you that compounds every single year without you seeing it. I call it the Dividend Drag Tax. It is not a penalty. It is the tax code doing exactly what it was designed to do. But most investors at this income level have never calculated the actual dollar figure. Here's the mechanism. VYM, Vanguard's high dividend yield ETF, yields roughly 3% annually. On $100,000 invested, that is $3,000 in dividends per year. Those dividends are qualified, which means they get favorable tax treatment. But at $250,000 in household income, you are squarely in the 15% qualified dividend bracket. And once your modified adjusted gross income crosses $250,000 as a married couple, the net investment income tax adds another 3.8% on top. Combined effective rate, 18.8% on every dividend dollar. Every year, automatically. So that's $3,000 in annual dividends. The IRS collects $564 before you reinvest the rest. That does not feel devastating in year one. Run it forward 10 years. Picture two bars side by side. The left bar is VYM. The right bar is VUG, Vanguard's Growth Index ETF, which yields about 0.5% annually. Same $100,000. Same 10 years. Both sitting in a taxable brokerage account. The dividend drag tax hits the left bar every single year. A portion of every quarterly payment leaves the account permanently before it can compound. The right bar is different. VUG's gains sit inside the fund, growing without interruption, because you have not sold anything. The IRS can only collect capital gains when you realize them. That is what I call compound deferral. Your growth compounds untouched until the day you choose to sell. The left bar shrinks a little every year. The right bar does not. After 10 years, the two bars are not close. S&P Dow Jones Indices data through March 2026 shows the S&P 500 Growth Index returned 15.9% annualized over 10 years. Vanguard's performance data puts VUG's 10-year CAGR at approximately 17.65%. VYM came in at approximately 11.78% over the same period. Before a single dollar of taxes, run the compound math. $100,000 in VUG grows to approximately $510,000. The bar just grew. $100,000 in VYM grows to approximately $304,000. The gap before taxes is already $206,000. Now layer the dividend drag tax on top. VYM's annual tax burden on dividends, compounded over 10 years, removes an additional $7,000 to $10,000 from the final balance. The right bar is not just taller, it kept growing faster because it was never interrupted. Now I can hear the objection forming. You might be thinking, Sarah, growth ETFs still get taxed when you sell. That is correct. When you liquidate VUG, you pay long-term capital gains. 15% federal plus 3.8% NEI if you are still above the income threshold. So the final number after sale is not $210,000 clean. After 18.8% on roughly $410,000 of gains, after-tax proceeds land around $433,000. Compare that to VYM's after-tax balance of approximately $294,000, after accounting for annual dividend drag plus capital gains on the smaller gain pool. The gap narrows from $206,000 down to approximately $139,000. Still $139,000. Still a meaningful number on one account location decision made 10 years ago. But there is a second layer most people miss. Compound deferral gives you control over timing. With VYM, the tax event happens every quarter whether you want it or not. With VWAG, the tax event happens when you decide. If you sell in a year when your income is lower, perhaps you retired. Perhaps you had a career transition. You might drop into the 0% long-term capital gains bracket. Married couples with taxable income below roughly $97,000 pay 0% on long-term capital gains in 2026. 0. The dividend drag tax offers no such option. It hits at your current marginal rate every quarter, regardless of where you are in life. Here is the condition that makes all of this true, and this is the part that most videos on this topic skip entirely. If your dividend ETF lives inside a Roth IRA or a 401k, the dividend drag tax does not exist. Dividends compound freely inside a tax-advantaged account. The case for dividend investing in a retirement account is completely intact. Everything I just showed you is scoped to taxable brokerage accounts at Henry income levels. Change the account type and the math flips. Drop the income level below $97,000 as a married couple and the math softens significantly. At 0% qualified dividend rates, VYM's behavioral advantages may outweigh the tax drag entirely. There is also one more thing I have not fully resolved. If you are retired and living off your portfolio today, the income argument recalibrates. Dividends as living expenses remove forced sale risk. That is a structural benefit the after-tax math alone does not capture. The framework I am giving you is for investors in accumulation mode. Adjust accordingly if you are drawing down. I want you to leave with one clean framework. It is not growth beats dividends. It is what account and what income. Those two variables determine everything else. Before you do anything with this, answer one honest question. Have you ever panic sold during a market downturn? If yes, your behavioral profile is part of the calculation, and dividend investing may be the right answer for you regardless of what the spreadsheet says. A 60% return in an account you held through the crash beats a 90% return in an account you exited at the bottom. Here is the protocol. Step 1. Identify where your dividend ETF actually lives. Log into your brokerage account right now. If it is inside a Roth IRA, a 401k, or any tax-advantaged account, the dividend drag tax does not reach you. You are done. If it is in a taxable brokerage account, move to Step 2. Step 2. Calculate your annual drag in dollars, not percentages. Take your Dividend ETF balance, multiply by the fund's yield, then multiply by your effective qualified dividend rate. For most Henrys, that rate is 18.8%. That number is what leaves your account every year before compounding. Write it down as a dollar figure. Seeing $500 versus 0.5% changes how the decision feels. Step 3. Make an account location decision, not necessarily a fund switch. The cleanest move is often not to sell your Dividend ETF, but to relocate it. Hold VYM or similar inside your tax-advantaged accounts where dividends compound freely. Direct new taxable contributions toward a growth or total market index fund where compound deferral works in your favor. The two strategies stop competing and start working together. $139,000 is not a small number. It is the compounded cost of an account location decision that most investors never thought to examine. That is not a failure of discipline. It is a failure of information. And information is the one thing you can fix today. I want to hear from you in the comments. Tell me where your Dividend ETF actually lives. Taxable account, Roth, or 401k? I read every single comment because the patterns and where people hold these funds tell me exactly what to cover next. If this breakdown gave you a number you did not have before, hit the like button. It helps Sarah's Money Map reach more investors running this same math without knowing it. And if you want more deep dives that skip the hype and show you the actual numbers, subscribe. I will see you in the next one. For learning and entertainment only. Nothing in this video is personal investment advice. All investing involves risk. AI may support parts of the production, while I, Sarah, personally review and edit every video.